everyone. Welcome to IGCSE Accounting. Today we want to talk about the account procedure, which is relevant to capital and revenue expenditure. Before we go into the details and the practicals exercise, we would like to make a very clear definition of what is capital expenditure. Okay, business expenditure that used to purchase or improve asset that are expected to be used in the business for more than 1 year. It also includes the cost of getting those assets ready to use. Capital expenditure is not classed as an expenses on the income statement of a business. Okay, so in the other word, for example, you are purchasing your equipment, which is you're expecting to use more than 1 year, then it will classify as a capital expenditure. In the other word, for example, some expenses, for example, you are renting an office. That is every year you are paying for the rental is considered expenses. Then it will actually classify under the expenses in the income statement. Okay, so there is some differences you can judge based on how you purchase the thing, and then it will last for very long, more than a year. If not, then it will be under the other one. Okay, what is the other one? Let's have a look. The other one is revenue expenditure. Expenditure that during the business is clearly linked to the specific time of the period. For example, just now I gave the example about the rental, right? You are paying every month for the particular period of the month. Revenue expenditure is classed as an expense on the income statement for a business. Okay, and then let's have a look of one example. This example is page 1, 2, 3, and then let's have a look of the first item, which is cost of purchase a truck. So a business want to purchase a truck, and the truck costs 20,000. All right, and pin of business logo, the sign on the truck is cost 600. Replacing the worn tires is 500. The fuel cost of the year is 2,000. The insurance of the year is 1,000. Purchase of the new engine for the truck is 3,800. Okay, now we would like to have a look of how we classified it. As a capital expenditure, it actually is the cost of purchase of the truck is 20,000. And the painting of the business logo on the side of the truck is 600. The painting of the sign, it will last for more than a year. That's why it's 600. And the other thing is you purchase a new engine, which is 3,800, will last for quite long as well. So the total capital expenditure of 24,400, it will classify under asset, which is capital expenditure. It will not be recorded in the profit and loss, which is the income statement, as an expenses. However, just now there are a few things like fuel cost of the year, specific time, right? Insurance of the year, specific time, right? And the other thing is the tires, which will not last for that long, which is more than a year maybe. So these three will parking under the revenue expenditure, but not capital expenditure. I hope I make this very clear. Okay, we will go through a few more examples in order to clarify this. All right, let's have a look of another things that we want to clarify here, which is capital receipt. That means income. The proper definition is the business income that is not part of the day-to-day operation of the business. The capital receipts are not classed as an income on the income statement of the business. That means when you calculate your profit and loss, this will not consider an income. For example, you are purchasing some goods for resale purpose. That is for your resale purpose. It will not when you have this kind of after you resell, the income will not classify as a capital receipt. Then what is considered capital receipt? Later we have a look of it. There are some examples that show you. Then what is revenue receipt? Business income that comes from the day-to-day business operation. Just now I gave you the example. You purchase the goods and then for resale. That one is considered the sales itself is a revenue receipt. Okay, revenue receipt are classed as an income in the income statement for the business. Okay. Okay, let's have a look of one of our example so that I can show you how it. Okay, this is a business which is running a clubhouse. All right. So a clubhouse, there are many possible expenses and also income. The sales of clubhouse equipment, that means the company, the clubhouse business, they're selling the equipment inside the clubhouse. All right. These sales of equipment, normally equipment actually classified as an asset. So when the asset is sold, asset is not purchased, the equipment is not purchased for trading purpose. Equipment is normally used for own use, the business own use. So it will not classify as a revenue income, a revenue receipt. It will classify as a capital receipt. Okay, it normally won't happen. You don't always sell your office equipment from day to day operation. Am I right? You, for example, like photostat machine. Okay, you don't buy and sell unless your business is photostat machines dealer, a trader. Then you, of course, you will have this kind of trading, which is photostat machine. You will consider as a revenue receipt. But is the sales of the clubhouse equipment, which is not really doing equipment sell. All right. Okay, purchase of the supplies. That means on and off you purchase some of the things that which is the clubhouse need to use. So ongoing is a revenue expenditure. Okay, then the next one, wages paid to the workers in the house. This one also can consider an expenditure because it pay for the expenses and it all actually means to particular period of time. Okay, the next thing, purchase a new television for the clubhouse. So this television will place in the clubhouse and is considered an asset. And this purchase, this item will last for long, just like the equipment, same thing. All right. So it considers an expenditure. All right, but it's not under revenue expenditure. It's considered capital expenditure. Okay. General expenses of typo, not all, of the clubhouse. So there is some general expenses that you need to spend. Okay, it's purchase or supply is the same thing. So it's revenue. Revenue receipt. Expenditure. Sorry, revenue expenditure. Oh my god! I just realized that wages is receipt, purchase of supplies of clubhouse. Purchase of supply of clubhouse. Yes. Okay. Yeah, correct. Okay. Annual subscription fee is received from the club member. So this is a clubhouse, right? So they collect members' fees, which is subscription fee. All right. It's an income. Income is considered a receipt. All right. Receipt. And this one, annual subscriptions, that means particular year. So it's considered a revenue receipt. Okay. Grant received from government to develop the house. Okay, the grant, government give you some money to put into the renovation purpose or other purpose. So this is not normally income, it's capital receipt. It means you don't always receive this kind of fund and money into your business. So it's considered a capital receipt. Delivery cost for a new television used to be to use in the clubhouse. So for this item, okay, is considered because this one is for the TV, the television to come in, consider a capital expenditure. All right, and then the last one, the sales of the refreshment in the clubhouse for the snack bar. So we are doing some sales. We sell some refreshment and income. So it's a receipt. But this one is ongoing operation thing. So it should be revenue receipt. So this is the example that we want to talk about. So that's all for it. And then in the next video, we want to talk about the implication fact that if let's say you classify long reward